Good afternoon, everyone. Thank you so much for joining in. Welcome to India Factoring and Finance Solution Chat Show, Factoring One Stop Solutions for Your Global Aspirations. I'm Renu Bilwara, Assistant Vice President, Relationship Team West, India Factoring and Finance Solutions, and I'm your host for today. We will be discussing the topic Major Economic Challenges and Working Capital Solutions for Businesses. Before that, let me introduce India Factoring and Finance Solutions to you. India, Fac- India Factoring offers working capital solutions through factoring product aimed at converting your receivables into cash. The company is a subsidiary of a European bank, Bank Malta, and is registered with RBI as NBFC Factor. India Factoring is also 83 category authorized dealer. Through our global network, we offer one-stop shop solutions and receivable finance. Now, I would like to take this opportunity to welcome our eminent speakers. Our first speaker for today would be Dr. Shubhda M. Rao. Dr. Shubhda M. Rao, founder Quantico Research. Dr. Shubhda brings with her over 32 years of experience in academia and industry, a gold medalist and a PhD in economics from University of Mumbai. She has worked as chief economist with marquee financial sector entities like Times Bank, CRISIL, Kotak Institutional Equities. She began her corporate career with ICICI as an economist in planning and treasury department. Prior to setting up Quantico, an independent economic advisory firm, she served as a senior group president and a chief economist at Yes Bank for over 14 years. As thought leader, she has extensively made presentations on Indian economy to Indian corporate leadership team and boards, Federal Reserve, Bank of England, Bank of Canada, G20 IIF meetings, ministers and delegation secretaries of state of various countries. Her views are often aired on marquee electronic and print media, both domestic and global. Dr. Shubhda has held position in various industry associations, including Bombay Chambers of Commerce and Industry, National Economic Policy Council, ASSOCHAM, India Bank, and India Bank Association. Under her leadership, her team at Yes Bank was often ranked among top three forecasters of India economic indicators by Bloomberg and was cited as top forecaster for currency by Reuters in the past. Welcome to the chat show, Dr. Shubhda.
Thank you, Renu. Thank you, India Factoring, for inviting me and Quantico broadly to share our economic outlook as it stands today. We are in extremely volatile times, and this offers a great platform to exchange a lot of thoughts around this subject.
Thank you so much, Dr. Shubhda. Now, I would like to bring in our next guest, Mr. Abhijit Angne, Regional Business Head and Senior Vice President, West, India Factoring Finance Solutions Private Limited. Abhijit, a CFA professional, is a knowledge leader with over 20 years of banking experience, primarily in trade finance and forex. He has conducted guest lectures at premier B schools like SP Jain School of Global Management and has presented on trade finance solutions at various industry associations and leadership summit event organized by various associations like World Trade Center, BSE, SME Chamber of India, and many more. Prior to India Factoring, Abhijit has worked with Edelweiss Financial Services, Yes Bank, and Standard Chartered Bank. Welcome to the chat show, Abhijit.
Thanks, Renu, for this warm introduction, and indeed my pleasure along with Dr. Shubhda. So thank you very much, Renu.
Yeah. So before we start off with the chat show, I would like to inform our audience that we will be running a live Q&A session towards the end. So request you to put down all your queries in the chat box mentioned below. Yeah. So as we are all aware that we were just getting over or we were just recovering from the pandemic wounds, and now this geopolitical crisis has come into picture, which is basically creating a supply chain destruction and creating shortage for raw material and price hike. So we will be understanding the impact of this on our global economy. So for this, Dr. Shubhda, I would like to understand from you that with all this conflict and we are likely to be heading towards a fourth wave. So where do you think we are headed? And what do you think would be the impact on Indian
Yeah,
economy and exports for us?
sure. Thanks, Renu. At the outset, if you could just call me Shubhada, that's perfectly fine. Quite clearly, India has been, and like elsewhere, all the regions and economies have been grappling with COVID past 2 years, and each of the country had its own way of mitigating the risks arising out of COVID, both from the government side and the central bank side. The policy support was completely leaning on focusing on growth and getting the economies out of the low and contractionary phase in growth for past 2 years or so. Quite right that India also was showing a recovery momentum taking shape uh, since we left behind the two big COVID waves and very recently the January Omicron COVID wave. India was showing a good pickup in growth momentum. But however, we should not forget that over the last 2 years, India has actually seen a fair bit of economic scarring. What do I mean by it? That if COVID had not happened, India's growth trend would have been much steeper and much more impressive. But because of COVID, what we have seen is while the GDP or the gross domestic product level may be achieved to the pre pandemic levels, the growth trend will perhaps take at least 5 to 7 years to take shape and to play a catch up. This is not unique to India. Everywhere we have seen a dramatic cutback in growth drivers, be it consumption, be it investment, or be it to some extent global trade. All of this was actually looking to get better. For India in particular, what really supported India's growth over the last 2 years were three engines. One was very clearly agriculture, which had a strong support. The next was the biggest growth support coming from the government side, that is government consumption, the capex recovery, the capital expenditure incurred by the government, bringing in fold a little bit of appetite for the private sector to come into the fray. And of course, the global trade was not doing too badly either. Let's not forget, I think very recent as recent as last night, we have a number of India having touched 400 billion in exports. Overall, for the year, we've looked at a 38% growth in exports, which is very impressive coming out of COVID. And going forward, what we now have is a huge hurdle, namely the Russia Ukraine conflict. What it does is very clearly brings to fore the concerns on commodity prices, which were already elevated. But if you look at the CRB index, it is 25% up since January. We are also looking at supply chain bottlenecks getting prolonged, be it through the semiconductor shortage or more importantly, the energy crisis. I would like to call it crisis because we are heading to one kind of high risk event, which is of very high energy prices, because Russia is a big player for the world to support through energy supply, particularly through natural gas into eurozone, in particular more so. So energy will be affected, energy costs will be affected, the logistics will once again get impacted because coming out of COVID, we were still recovering from the logistic costs, the logistic bottlenecks. Let's not forget they were, rising. Logistic costs were rising by almost 7 times to compared to a 2019 level. So put all together, while for India recovery has been, slow and steady, but this war also puts additional challenges in terms of high input costs, higher inflation that uh, India can tolerate, which in turn would put some affect the interest rate trajectory going forward into India. But more importantly, the trade aspect that you raised is a question. I would believe that while India may not replicate the 38 to 39% growth in exports in the forthcoming fiscal year, but we may still do better in terms of 13 to 15% growth. Of course, the key caveat is how long do we see this conflict, in terms of intensity, in terms of duration, to play out in the world, and that would, basically pave the way for whatever trajectory we look to. As of now, we do see downside risks to growth, Renu. We were looking at a 7.5% growth, but clearly downside risks are, looking larger in terms of probability. And of course, the trade, as I said, would be relatively subdued compared to the preceding year, but all the risks would be on a watch mode as an analyst for us.
Right. Very well explained, Shubha. Actually, with this world which is highly integrated, I think this is one of the risks also that we have, that where the capital and the growth happens, we are open to expose to such kind of risks also because of the high integration
Absolutely.
across the world.
Yeah.
Yeah.
Yes.
Abhijit, if you can share your views also on this.
Sure. Thanks, Reno, and thanks, Shubda, for this very well explained. Now, if you look at it, I think 400 billion exports, what we have achieved so far, and now we are talking about $410 billion. Although, of course, it's a remarkable journey, almost a growth of 37, 38% from last year. But now let's take it, I mean, the practical aspect of it. I mean, look at the China. Of course, the exports of almost $2.9 trillion. Absolute no comparison, where we are talking about $400 billion. Okay. Now, the I was other day I was speaking to one of the client, okay, and he is a major exporter of steel products to European countries, and I understand that almost 24% of steel gets imported from Russia and Ukraine. Now, where will this business will grow, and where will this particular, uh, the which countries will have a upper hand in winning this particular business to Europe? Already, if I talk about China, there is an anguish getting developed against China in Europe as well. There is another contender, which is Vietnam. Now, the aspect is Vietnam is the transit time is almost 15 to 20 days higher than India. Moreover, the logistic cost, as Shubha has rightly pointed out, is 30% higher than what the India's logistic cost. So I feel that India has a very, very strong possibilities of getting this kind of business, which probably some of our competition might not have an upper hand here. So I think golden opportunity for India. But having said this, the journey won't be that easy because raw material prices are also, because of the crude moment, raw material prices are also skyrocketing. Prices for steel, crude oil prices. I think, including logistic cost also is it's highly volatile here and it's skyrocketing right now. So it's going to be a very interesting journey. But having said this, there is a hidden opportunity for Indian market way forward. So although $400 billion is a great achievement, 37% looks really good. But now it's all about how to continue this momentum. That's very very critical for
Yeah.
Indian exporters.
Yeah, thanks for your views, Abhijit. Shubda, there are few questions which are coming from our audience, which is
Mhm.
related to the topic. So I'll take it up. So the question is from Mr. Akshay Bhardwaj. Now that Russia have demanded the EU pays for the gas in ruble and not in euro and USD, how do you see this impact EU credit risk in general and impact on India, if any?
No, I think this is playing out in recent weeks, that the rupee ruble trade also is getting spoken about and actively under consideration. We also see Russia wanting and insisting on ruble and not USD or euro as the currency for trade goods. Uh, I think it's an attempt by Russia to probably get the attention towards its own currency, because ruble is otherwise going to be, I would say, a victim of, I wouldn't call it a victim, but actually a lot of sanctions, economic sanctions, are going to adversely affect the ruble trade. So at least with the regions and countries that Russia is still engaged in trade, there is an active conversation of rupee ruble trade. India herself is talking and exploring for Indian companies to look at this. Would it be just rupee ruble trade, or would it be through a peg of either a USD or a euro for India to fix a ruble value? I think that is still getting explored and actively under consideration. Early days yet, but I would still believe that at least the trading partners which are still, have some trade interest going alongside Russia, would actively consider ruble also in the currency baskets, particularly for energy or for industrial metals for that matter. Let's not forget, for semiconductors, a lot of the sourcing of metals comes from Russia and Ukraine, and Russia in particular. So together, for example, palladium, I think a major part of it is sourced through Russia, and to some extent through Ukraine. So there would be a switch to the ruble trade, but how is it going to play out? I think a lot currently depends on the sanctions, because a lot of financial companies have also exited Russia. A lot of non-financial companies have exited Russia. So I'm not clear at this juncture how actually it will start, make a meaningful kind of a volume in terms of the ruble-led trade as a currency pair.
Thanks, Shubda. So, in continuation with the previous question only, like you mentioned, two of the sectors that are majorly going to get impacted is energy and logistics. So, along with that, what are the other sectors you are expecting that are getting to get impacted in near
Yeah.
future?
Yeah. No, actually, that's a great question, because everyone asks that how directly is it going to impact my economy, particularly if the conflict is far more extended than beyond a month, which it already has been. I think oil, of course, is an all-pervasive, channel through which economy is going to get impacted. Manufacturing, services, transportation, etc. Brent trading at 120 has a larger implication for India's macros, both through inflation channel, through trade channel, and also through the government finances channel. So I'll come to that in a bit. But coming to your question specifically on what are the sectors, now we do see, as I earlier spoke of, is there was already existing shortages in semiconductors. Because as Abhijit also alluded to earlier, right since the outbreak of COVID 2 years ago, there was a basic realization that had dawned, which was that you need to have a China plus kind of a strategy, where we are looking to explore, an undisrupted trade kind of movement. So clearly, India came closest to be looked at as far as China plus strategy is concerned. Semiconductors is one such item on trade, which actually has an all-pervasive impact, be it on automotive sector, be it in electronics, on health, on every possible financial sector, because the chip matters in a highly digital transformation of all the economies in the world. Chip becomes very important, chip manufacturing. And today, that semiconductor shortage is something that is likely to get prolonged. It's not just because of the shortage of raw material used for semiconductors, like a neon gas or a palladium, which I said, a large part of it comes from Russia, Ukraine, and also from Taiwan. So all these, will have a bearing on the, certain items of trade, particularly, and how do they impact on India's sectors? I would say, in addition to energy impacting a large part of the manufacturing sector, specifically, we would see a prolonged pain point in automotive, in consumer durables, in some of the services sectors. So we need to see how best we are mitigating that. This is a work in progress. Government rightly announced, PLI is the production linked incentive scheme for semiconductors. But obviously, you cannot imagine a production, happening within a year, but it at least paves way going forward to for the world, not just to look at one region, one economy. I think the basic theme, Renu, what comes to fore in last 3 years, be it COVID or be it the Russia-Ukraine conflict, is that over dependence on just one single economy or region for trade is harmful and disruptive for rest of the world's economic momentum. I think that is going to be a biggest lesson learned. Mind you, going forward, we are going to have a lot of redrawing of the trade map. And I think Abhijit must be already witnessing that at the ground level, as to some lot of queries coming your way at India Factoring also, that what are the alternate destinations that one could look at in terms of the trade channels getting redrawn, rethought, trade agreements getting rethought, and so on.
Right, right. Very correctly said, Shubda. Yeah. So in with this only, like Shubda said, that we are getting India Factoring must be getting multiple queries. So in this only, we wanted to understand from you, Abhijit, that what are your suggestions for exporters for working capital finance, and how would the current scenario impact the export factoring business in India?
Sure. Indeed, Shubda, I think we are getting good amount of queries, and we are already witnessing in terms of numbers also. And being a market leader, we can easily foresee such kind of opportunities in the near future as well. Well, just to answer Renu's question here, now let's look at we already discussed there are hidden opportunities, there are possibilities, as Shubha has rightly pointed out, that nobody would like to depend only on uh, one region rather. There has to be some alternative apart from China. Now, in this direction, there is a high possibility that way forward growth will come from SME and mid corporates. Now, as on today, if I look at it, 4 crore SMEs contributing around about 40% of overall trade per se. Now, if I look at it, the China, even if I look at their economy size of almost $14 trillion, the SME contributes around about 60 odd percent, and that's a very high number. Now we have opportunities here and we have SMEs here. Now I understand from a recent report from World Trade Center, there's a shortfall of funds of almost 2.3 trillion INR for these SMEs. Okay. Now why this shortfall? Okay, because many of those SMEs don't have a collateral, first of all, because unlike with corporates and all those, many of SMEs, mid corporates don't have these collaterals. More or less, I think right now in this current situation, the raw material prices have increased. I mean, you talk about coking coal, see the prices there. Talk about any crude oil kind of any raw material related to crude oil. You see the difference in terms of prices, logistic costs also. So the current lines, what we are talking about, are not sufficient for SMEs and the mid corporate companies. There are many SMEs and mid corporate companies approaching for PLIs, approaching for capex plans, and there'll be always a possibility of scarcity of this, working capital shortfall. And that is where I believe that innovative trade finance, like a factoring, wherein no collaterals are required, there is absolute no requirement of any kind of, it's a 100% without collateral, and this is how I believe such innovative finance will always help. Moreover, there is a uncertainties in the market, and the without recourse finance like factoring will also cover the risk of a buyer, repayment from a buyer, because this is going to be without recourse. most of the mid corporate companies aspiring to become listed entities, and this finance will not appear on the balance sheet because this would be an off balance sheet finance what we are talking about. So this would further help them to deleverage their balance sheets, and will improvise their overall credit risk rating, and likewise their valuation whenever they would be becoming a listed entities down the line. So I believe now it's a need of the heart for a innovative finance like factoring, export factoring. If I look at it today, the volume on the export factoring for India as a market is way lower than what we are talking about. In India is not even $2 billion as far as the export factoring is concerned. If I look at it, the overall exports of almost $410 billion. In China, it's almost $60 billion, more than $60 billion. So now it's a high time for Indian, we have to create such kind of awareness for this innovative finance. There has to be support from regulators. So see, बोलने से $500 billion exports नहीं होगा. There has to be some kind of action needs to be taken by the
Yeah,
regulators also and all the stakeholders in the industry. Then.
true.
Correctly said, Abhijit. Yeah, regulators have to take their required steps and mitigate this particular and help us mitigate this particular crisis. Yeah. So Shubha, I'll take this question for you from Mr. Ramanathan. That just wanted to know the level of acceptability of SPFS, the Russian equivalent of SWIFT, in world trade right now, from the transaction point of view. Yeah.
Yeah, I mean, I was reading this question, Renu, while Abhijit was also speaking about it. Unfortunately, I have a limited exposure to the SWIFT part of trade. Being an economist, maybe I think Abhijit could throw some light on it. But, on the payment platforms, I wouldn't even want to venture out in, guess making a guessing game of what the question is all about. So I just have to excuse myself. Maybe I could do a little bit of a homework and come back with a response to this.
Sure, sure. Abhijit, what do you think about this particular acceptance of
I
SPF?
think very good question Ramanathan has raised, Ramanathan. So in a trade, without, I think SWIFT becomes a very backbone of any trade transaction. So without a SWIFT or authenticated messages, nothing can work out. No remittances, no SBLCs or any bank guarantees or LCs, or you talk about anything on the trade without SWIFT, because this is the authenticated way of communicating between two banks. Now coming back on SPFS, although yes, there is a possibility here, there is a remote possibility here. Now need to understand that how many banks will participate there, okay?
Yeah.
Because as of now, the one is the communication, and another aspect is the underlying currency, because underlying currency will always remain the dollars, okay? And all the notional accounts will be always at, based out of US. So all the communication channels may be SPFS, or there might be some possibilities, but the real need right now is the any mechanism which with the use of SPFS. It's all about the participation of banks. How many banks? And most of the banks are European banks and US banks. There'll be a strong resistance because people are now talking about sanctions on Russia and all those. So how would it be possible? So one is a part of communication and one is a part of execution. So communication may come across. There might be some kind of innovation, probably bilateral kind of communication between, say, the friendlier nations with Russia. But the execution in terms of the final execution, which will ultimately depend upon the participation from all the banks. So too early to comment here, Ramanathan. But as of now, I think there is a remote possibility for implementing this SPFS as well.
Totally agree. If tomorrow implementation of this particular thing will become a challenge, even if
Yeah.
as an alternative method you want to accept it, implementation will be a major challenge.
Yeah.
Yeah. So I think KPS has put up a point that it may reduce the scope of other borrowing. Book
The
debts
borrowing,
will also
yeah.
be available as security
True.
in that particular point of time. So another thing that a lot of major economies that are facing because of this particular ongoing challenge that we are facing is rising inflation. So where do you think this is headed in India, and what should be the ideal approach of the regulators to mitigate this,
Sure.
to control it?
I think inflation has been and will continue to be the biggest bane in terms of balancing for most of the policymakers growth vis-a-vis inflation debate. Now, we all have seen that COVID and the fallout of COVID in terms of supply shocks, logistic costs, etc., has already been playing out on the developed markets. We know that the Fed had been talking of inflation being transitory, and they had to change the track and call it that it is getting a more durable nature. And likewise, not just the US, Eurozone, UK, all the developed and advanced economies have already been grappling with a 4 decade high kind of inflation level. For instance, in US, it's about 7.5 to 7.9. UK yesterday saw inflation going to a 40-year high to 6.2. So clearly, COVID and now the Russia-Ukraine conflict, working through the channel of commodity and other input prices, has begun to disrupt the normal acceptable inflation trajectory, and emerging economies with being no exception. Coming specifically to India, I think let's not forget that since India embarked on inflation targeting regime, by and large, inflation has been well behaved, has been well managed. Inflation expectations, which have a role to play, have been well anchored, I would say. Of course, post COVID, we saw inflation inching up because of the factors that I just spoke about. However, as targeting central bank, the Reserve Bank of India had appropriately put the band between 2% to 6%, a 4 percentage wider gap or wider band was being put forth through the inflation targeting mechanism. Now, 2% obviously nobody's looking at. What India did see was inflation over the last few months inch up to 6% and a couple of times over 6%. Does it disrupt the RBI's calculations? Perhaps the Russia conflict will do that. Not too long ago, in the recent monetary policy, the RBI had put out a forecast for the next fiscal year at 4.5%. And subsequent to the Russia-Ukraine conflict, the Reserve Bank of India has been highlighting and flagging off the possibility of inflation forecast being revised upward. There has been a bit of a disconnect between the central bank and the markets. Markets were already anticipating high inflation. We, for instance, are looking at inflation to move from, say, 5.5 in the ongoing fiscal year, which will close in a week's time, to go up to about 6.1 to 6.3%. And to us, that will begin to start having some impact on the shape of the monetary policy. Why do we say that? Is it's not just food prices may still get managed, though a lot of interplay between the global food prices and more than robust food grain domestic output will have some interplay through government channel, through policies and so on. Food prices may not be the concern at all because of the bumper crop. What would be of concern is core, the non-food prices, core inflation, which is non-food, non-fuel, but more importantly, the fuel prices. We all know that 10% increase in crude prices has a larger bearing on, as I said, on all the major macro parameters. How does it work on growth? Maybe by 20 basis points. If crude prices go up by 10%, the GDP impact, the growth impact is of 20 basis points. What is a larger impact is the consumer inflation. A 10% increase will look to impact consumer inflation by 30 basis points. And today we are sitting on a $120 a barrel kind of price on Brent today. We had closed the year of the current year at 80. If I'm looking at 120, which is a good 50% rise, has an impact of 1.5% upside move. The scope could be a 1 to 1.5 side upside move in inflation. So clearly, inflation would be the biggest risk, not just for advanced economies, but has begun to inch up for economies like India. And that would start prompting the central bank, the Reserve Bank, to work on the interest rates, which so far had been very accommodative. Mind you, even if they raise interest rates, the real interest rates would still remain in the negative territory, adjusted for nominal interest rates, adjusted for inflation. They would still remain in negative territory for a third year in running. But the fact is, the headline consumer inflation will pose risks between the growth inflation balance that central bank is striving to achieve at the optimal balance. RBI will be exploring to look at raising rates probably starting August of 22. uh, Between now and August, RBI would like to restore the lower end of the interest rate corridor to its normal level. Currently it is at about 65 basis is the corridor. It would want to restore it back. It may happen as early as in April policy, but to just for the long answer to be summed up, inflation will be a concern for India going forward, and we cannot, be relaxed about this risk that could hamper growth as well.
Correct, correct. That's correctly said. It's more of like a cost push inflation that is
Absolutely.
going to affect the in near future. Yeah. So I'll take up the next question from Mr. Ashish Somani. That India achieved 400 billion export target. How much volume can we expect considering the fact India would get benefits from Russia-Ukraine war? So Abhijit, would you like to take up this question?
Yeah, so thanks, Renu. And again, a good question. 400 billion exports is again a remarkable number, almost 37%, 38% in last 1 year. But having said this, from 400 to 500 billion or whatever incremental, as I said that, almost 20% is export from Russia to Europe, and almost 9.6% is a still exports from Russia to all entire world. It's a very large quantum. I feel it would certainly would help India to achieve this 500 billion kind of number. But having said this, the journey won't be that easy. It would be a Herculean task to achieve this $500 billion because, as Shubha rightly pointed out, there'll be concerns for inflations. First of all, there'll be concerns for incremental working capital also. There'll be concerns for raw material prices because I don't know how long this will go on. Look at the Brent oil. Today it's hovering almost 117 as we understand that from $80 per barrel to now 117. So it has always a ripple impact on all these raw material prices, and most
Absolutely.
importantly the availability of the logistic also, because there are some container issues what we witnessed few months ago, and the logistic cost is also, I think, 6-7 times. Even someone will understand that what exactly the 6-7 times is, almost 700% increase in the logistic cost in last few months itself. So yes, there is a possibility here, high possibility here, but very very interesting to see that how India can cash in this particular opportunity from here, from 400 to 500 billion dollars. I think appropriate stance from Indian government also is extremely important. I think they abstain from voting, but there is a pressure from Quad partners also. Everybody is talking about why India is abstaining from from their vote, but it's all about how diplomatically they manage all those aspects. Because end of the day, it's how the country would benefit from this particular situation, geopolitical situation. So it's a wait and watch right now. Many of those exporters, what I understand, not taking the fresh contracts because of, as I said, the raw material prices have even eventually increased a lot, and they cannot, it's not easy to amend the sales prices because the contracts have been already fixed. The prices of the goods have been already fixed, and at the same time, the supply chain is not it's a disruptive supply chain right now. So many of those our customers, what I understand, is right now keeping themselves cool and not taking any aggressive kind of new orders and all those. So it's a wait and watch right now. Most of the SMEs are right now following following right now,
Yeah.
unless there's a clarity of the situation way forward.
Yeah, correct. So I think even if government is giving incentives, I think it might be hindered by the raw material and the shortage of raw material
Yeah.
available in the country. Yeah. So Abhijit, with this exports growing in the country, there has been like factoring as a product has become a choice in lately. So I want to understand from you what are the advantages, like you can tell our audience the advantages of factoring as a product.
Sure. So I'll just share a small recent case success story. What has happened at India Factory. So there is one client as a listed entity on the stock exchange. Now, almost for 2 to 3 years, they were after the large buyer based out of US. This client is basically into manufacturing of solar panels. I purposely would like to highlight about this particular success story. Now, 3 years, their CEO, their business head, all they were after the buyer that I need a order. I am but they never got this any kind of order. In the month of Jan 2020, they got their first order from this large buyer based out of US. Vestas is the buyer. They given their first order, the order of almost worth 24 odd crores. They were very happy that they got this 24 crores order finally from this large buyer, who's to procure, from China. Okay. Now he came down in Bombay. The company is having, plant at in Maharashtra only. They came down at Bombay. Their banker was apparently being the PSU. They requested their banker, now I got this order. We won this order after Herculean efforts, and there was a rigorous follow-up from our side. I would like to have a enhancement in my working capital by almost 12 odd crores. Bank immediately said that okay, fine, we are happy that you got an order, but for this 12 crore lines, we need 15 crores kind of collateral. Promoters and CEO, they immediately retaliated to the banker that we given everything to you, including our personal bungalows as well, stocks, factories, and everything. Nothing left with us. Finally, they came down and met us at our Mumbai office. We given them a sanctioning export without recourse facility of almost 12 crores. Later on, we come to know why they got this contract, Shubda. They got a contract because of US-China trade war, basically. And uh, within 6 months, okay, and Anguish got developed once, I think, starting of this COVID in the month of February, March 2020. Within 6 months, Anguish got developed and he got a further or subsequent order of almost 180 crores. From this small order of 24 crores, he got an order of 180 crores. Within 7 months, they again approach us. Now we got an order of 180 crores. Now we have we request you to enhance our limits from 12 crores to 50 crores. And I'm happy to share with you, and it's my pleasure to share with you. India Factoring has sanctioned 50 crore lines without 1 rupee collateral within a span of 9 months, from 12 crores to 50 crores. And I doubt many of the bankers would have been apprehensive at that point in time. But we were there and we given them a sanction of 50 crores. So the company, like a listed entity, not only helped this facility without collateral facility of 50 crores, not only helped them to achieve the orders, what the incrementals order they received because of the US-China trade war. The entire 50 crore factoring facility was without recourse. That has eventually helped them to garner that kind of valuation in the stock market. That has helped them to create that kind of valuation. That has helped them to create the better risk rating. And the entire 50 crores was without collateral. That was most important. And that's why I believe that innovative trade finance is the need of the hour, which is without collateral, off balance sheet, without recourse. And most importantly, this will always improvise their credit risk rating also. All your banking facilities, what we talk about is collateral back. Almost 99% of the banking facilities is collateral back. And this will be always depends, it depends on your, working capital gap, okay, your DPs and all those. But however, the export factoring is on the basis of your futuristic orders, and that's a huge difference because many of those SMEs may not have a proper balance sheet, but most of the time bank will always sanction the facilities basis the strength of the uh, balance sheets. But this export factoring, I think more or less it is the most important aspect of the export orders, futuristic orders, and that's a huge difference between export factoring and the traditional banking finance, working capital finance from a bank.
Yeah, very well explained, Abhijit. Yeah, factoring is going to be the need of the hour going forward. Yeah. Shubda, I'll take up the next question from Mr. Vinod Chaube for you. How
Okay.
does the uncertainties of war getting extended would affect the neighboring countries of Russia and Europe? The budgets of these countries would be redrawn to increase spend on defense and oil. Food grain supplies from Ukraine and Russia would have impacted on food price. Is there an advantage for India to capitalize on the buffer grains in FCI go down?
I think it's a great question. And yes, I think if you've been tracking India's recent incremental developments on the trade side, particularly on agri commodities, you will see there has been a conversation on India having stepped up its exports of rice. And that, I think, is a beginning of how India could possibly approach, given the bumper crop that India saw of about 310 or 315 million tons of food grain. It's been a record. So it would definitely have a bigger scope and bigger role for India to explore. Looking at exporting items like wheat and rice. Of course, one caveat is all the trade is subjected to the trade agreements and WTO norms that India has got into. For instance, I read that the moment rice exports were accelerated from India, economies like US have lodged a complaint. US and Indonesia and other countries have lodged a complaint that how has India actually accelerated and stepped up exports of rice to other countries. So there will be certain boundaries of norms and negotiations that India has already got into, but potentially speaking, it definitely raises the scope of India wanting to look at upping its exports, particularly of food and agri, given the Russia-Ukraine crisis. Because while we import edible oils, but for other food grains, India has been an exporter. So yes, that could be very actively under consideration, I'm sure. Coming to that earlier, in continuation with what Abhijit was saying, that yes, we are currently facing all the shortages and so on. But at the same time, and I was just talking to Abhijit a couple of days earlier, that this PLI is, I think a terrific policy engine to get India very actively be looked at as a hub, a manufacturing hub for the globe. A case in point would be recently you may have read an anecdotal evidence of Apple, having produced a large number of its handsets in India. And if you look at the trade pattern, India's electronic imports are significantly high after oil. And, after oil, maybe gems and jewelry, electronics is in the top four items of imports. If we are able to execute, all our PLIs, particularly where we have core competencies, but we are still doing large imports, and attract a requisite foreign direct investment into these sectors, I think India has a great scope for, pushing its exports. And to that question, if the game is correct, if Russia-Ukraine conflict is, limited maybe for the next few days, and India gets its execution plan right, 500 then will not look like a humongous challenge. Is what I'm an eternal optimist. So I feel that yes, of course, optimist, but you have to be realistic about the ground realities of the Russia-Ukraine conflict, and how soon can the semiconductor shortage be restored? How soon can semiconductor production in India take off and scale up? So all these would be contingent on how well we execute it. But if I were to look at scope, India has a huge scope of focusing on its exports through the PLIs and FDI.
Yeah, correct. Textile would be another sector which
Absolutely.
will be impacted.
RMGs,
It's good.
ready-made garments are already, in the top five, top 10, sorry, top 10 items of
Yeah,
exports
that's
if
it.
you look at the list.
Yeah, correct. Correct. So one of the key questions now that all the exporters and importers have, like this is one of the main question they want to know: how do you see rupee movement against major currencies, primarily euro and USD? Yeah.
Okay, so the theme of this next few months or maybe a year is of USD strength. The dollar is going to be getting stronger. Two of the main factors that we look at is one, in addition to it being a safe haven asset, besides gold, the two more economic and fundamental factors is that US is finally getting into rate hiking cycle. And looking at the dot plot presented by the FOMC, it's looking to raise rates by seven more times in addition, including the one that it did last week of 25 basis points. And if you listen to the commentary from Fed chair and other members of FOMC, uh, we cannot really rule out a 50 basis point hike in the next review meeting, followed by another one in June. So the short point is US rate tightening cycle has begun, and has begun at a much accelerated pace than was getting earlier envisaged. The focus clearly for the US, the Fed, has shifted from growth to inflation. As I mentioned earlier, inflation at 7.9, and mind you, the target is 2%. So they are so far off wide, from the target of 2%. So they will have to bring back accelerated interest rate tightening. In addition to that, there is a wide anticipation of quantitative tightening getting effected in the US. These two factors, and plus the safe haven sentiment and etc., would drive USD strength. What does that do to the INR? Um, INR definitely will, in tandem, start to show depreciation bias building up. Uh, what would it do in terms of the pace of depreciation? I think the biggest factor, positive factor for India that stands and stacks up for India's favor is the RBI's brilliant strategy of building the war chest of forex reserves. Despite the FPI outflows, which we have seen in the current year going right up to 20 odd billion dollars, FDI, commercial borrowings have all held well for India to build its forex reserves. Today it stands at about, the latest data shows, $622 billion of forex reserves. It's a great risk mitigator in terms of any nervous sentiment that could potentially build up around the currency pair of USD INR. And in today's world, it's possible. I mean, you are, the currency trades are fraught with risks. You have to have your war chest right ready with you. Unlike the 2014 episode where India was caught on the wrong foot with inadequate forex reserves to be able to mitigate the rupee, downfall, and rupee, getting into a little bit of a tailspin kind of a thing at the time of taper tantrum. That lesson has been learned very wisely, and RBI has been sitting on it. So our call is that if we are looking at an average USD INR in the current year at about 76 quarter, we could look at USD INR going to 78 levels, for sure. And that is purely because our trade dynamics are going to change as well. We are going to see a wider trade deficit. We are going to see a wider current account gap. Last year it was about 1.5. This year this year meaning fiscal 23, we are likely to see trade deficit and therefore the current account gap as a ratio to GDP go even potentially up to 3% and maybe slightly above 3%. A lot depends on, once again, the caveat is always the duration and the intensity of the conflict. But if crude oil rests at 120 and not at 100, even at 100, India has a risk of a much wider trade deficit and current account deficit. But the short point is that all these factors will start playing on the depreciation theme gaining ground. Coming to INR Euro, I would think it would be more of a derivative of Euro USD. What is happening to Eurozone in terms of the impact of Russia-Ukraine conflict is far more significant on Eurozone on a relative basis compared to other regions. Eurozone will be grappling with a lot more difficulties because of the larger dependence for energy sourcing to Russia, and what would happen eventually. You already see Germany now rushing to Qatar and brokering a deal for natural gas with Qatar. As I said, you are going to see a lot of these things getting redrawn. But the fact is, Eurozone is more vulnerable because of its excessive energy dependence on Russia and the Nord Stream. A lot has been spoken about Eastern Europe. To Nord Stream 2 has been stopped by Germany. But the fact is, Eurozone will be vulnerable. So coming to your Euro USD question, and therefore INR Euro, I think we're looking on a relative basis, it moving somewhere in the 4 rupees to 5 rupees region, uh, uh, upward. I mean, on a weaker basis. But as I said, uh, in the thick of the crisis of conflict, no constructive view should be taken or even on a durable basis of 1 month on Euro USD, simply because you are seeing gyrations on Euro USD pair. When I last saw the level this morning, it was 109. And that was a technical level that was getting tested. So, as I said, each day is a new day for Euro USD. But clearly, the pair or the euro looks to weaken vis-a-vis USD for sure, and that would also start having bearing on the INR euro. So I would be less confident on giving you a very firm kind of a directional call on euro INR. I would be relatively more confident on giving you a directional call on USD INR, given what we have in terms of forex reserves denominated in the USD.
That was quite insightful, Shabda. So I think we are coming to the end of the chat show. We'll take up rest of the questions separately with our viewers. So before we end the chat show, I want to understand from you that how research and current update helps businesses and how Quant Eco reports are helpful to them.
Very quickly on this, I think I love talking on economics, but I'm just learning to be an entrepreneur. So 2 minutes on that. Quantico, the genesis of Quantico is to serve the corporate entities, financial and non-financial, as an outsourced in-house economist. Let's not forget, hiring an economist is not a very inexpensive proposition. It's not very cheap to hire a full-time sitting in-house economist. But at the same time, the kind of gyrations that one sees in the world economy, and it having its impact, positive or negative, on each one of your businesses, prompts you to be slightly more aware, slightly more, conscious of tracking the high frequency to medium to long term frequency economic indicators. And that's where Quantico comes in. We offer independent, unbiased, continuous kind of source of analytics through research reports, through consulting on the macroeconomy, through interactive sessions. So our whole idea was that there are a lot of entities which either cannot afford an economist or do not have an idea of getting a full-time economist on board. But should they be, devoid of any economic research inputs? Definitely not. Our attempt is, and it's an experiment. It's a new experiment, in India at least, because uh, nobody has been looking at economics as a completely independent outsource service. It gets bundled up with rating modules, rating agencies do that, other brokerage houses do that, but it's more in a bundled up fashion. hived off independently economics research is something that we are trying to explore to make inroads into, and I just hope the idea catches on. Globally it has begun to get accepted. Domestically I think we are hoping that the idea catches up very quickly.
Okay, that's great. Yeah,
Yeah,
thank you so much, Dr. Shubda, and
thank you.
thanks for such an insightful session. It was pleasure having you on the show, and we look forward
Thank
to
you.
having such more discussions with you in future. Yeah,
Look forward, and if anyone is keen to grab our presentation on what's happening around us in Indian economy currently, we'll be happy to share a presentation.
Sure.
that would be great.
We
Yeah,
have a
that is
structured presentation already with us, which we will be happy to share if the viewers and audience also would wish to get a copy of.
sure, sure. Yeah, thank you, Dr. Shubda, and
Thank you.
thanks, Abhijit. It was pleasure having you also in the show. Yeah, thank you.
Likewise. Thanks.
Yeah.
Thanks. Thank you.
Yeah, thank you so much, everyone. If you want to know more about factoring, you can reach us at our LinkedIn page, YouTube, or the contact details given on our website www.indiafactoring.in. We will be coming up with another interesting chat show shortly. Until then, signing off, your host Renu Balwara. Thank you.